So some more people to arrive at 8 o'clock. I might just cover off on a little bit of housekeeping first. So there will be a recording of tonight's event coming through via email tomorrow. Obviously, you won't have the opportunity in the recording to ask any questions, which I will be trying to stop and address as we're going tonight if they are relevant to the content we're covering. Otherwise, I'll gather them all up and work them through one at a time at the end of the session tonight, hoping for about 45 minutes with a question and answer session at the end. I do value your time, so I will get right to the meat of tonight as quickly as possible. If you have any audio-visual problems, please let me know. Please let us know on live chat on the ripehouse.com.au website. We'll do our best to help you. We're all on standby tonight to help out there. For those of you who have attended a webcast in recent times here at Ripehouse, there will be probably 50% or 60% of tonight that you will have seen before, but it is necessary to establish that baseline knowledge. We do things a lot differently around here at Ripehouse, and we really challenge the status quo. We really try and look into different types of research and question the normal way things have been done before. So to that end, we do have to cover off on the basics, the whys here at Ripehouse, what we do before we get into the meat of tonight. So the meat of tonight is March Capital Growth. We produce a monthly report which we painstakingly go through, myself and staff, to prepare, select our growth recommendations using the software just contained in that report, down to the street and property level for you to be able to take away, use in conjunction with the software to successfully purchase. So I'll jump right in. Please, if you've got any questions, it'll be great to still see those who you're just arriving now, that you can see and hear correctly. It'll be great if you can just say that you can over on the question side. So that's where you can mention any questions or chat over on the right-hand side of your screen as your admin panel. All right, let's jump in. Okay, for those of you that don't know, my name's Jacob Field. I founded Ripehouse back in 2011. I have been an investor for about 15 years now. I might go into, if you don't mind, I do want to just set the scene about where I have come from and encourage you to do the same. I'd love to hear about where you're located, how long you've been investing for, how long you've been looking at investing and learning, or where you might currently own properties, how they've gone for you. I'd love to hear a little bit about your story in the chat bar. But if you don't mind, I might jump in quickly and just set the scene around how I got started in property and what I've been doing. So I won't talk about Ripehouse to start with. I'll talk about me as an investor. That starts all the way back in the early 2000s. I'm actually located and from Hobart, Tasmania. I have, as you'll find out, lived and worked in Sydney for a good while. But my investing journey started down here in early 2000s. I'll grab the copy of the book where I did start looking into shares, and I'd saved up quite a bit of money in my early or late teens, and went down the sports car route and sold that, dabbled with some shares, and then I read More Wealth from Residential Property. I've just got it out of my bag by Jan Summers, going back to late 90s. That book really changed the way that I sort of could see property working for me. I could leverage into it. I could rinse, repeat, and you can flick to the back of it, and you've got all these wonderful charts about how you can project out your net worth, and all of those things got me really excited. I was very ambitious. I did come from a background where we didn't have much money. My dad was on the pension, but I had this burning drive to, I suppose, try and skip ahead of an income or a wage using property. So I was lucky enough to get started with my mum. Actually, we purchased our first house down here, early 2000s in Tasmania. That went really well for us. I was able to buy her out, buy another property soon after, and then went from there. We were lucky enough, I suppose, 2005 down here in Hobart, we had 45% capital growth as a city. It's the highest recorded capital city growth on record. Amazing. That got me really set up. And then I met my beautiful wife, Anna, and we moved to Sydney. Now, I obviously wanted to continue to invest and move forward in property, and we landed ourselves in Sydney, and it was a martial landscape. It was really something we weren't familiar with. I really couldn't get my head around after successfully investing in what I knew and understood and doing well. My comfort zone was definitely Hobart, and I could understand Hobart and own property there, doing really well. How do I apply that to Sydney? And that's when I really had a wake-up call. Through friends online back in the early 2000s, there weren't a huge amount of source of information, and definitely no webcast to join into. But I did make some friends in the property space via rudimentary forums and the like. Joined up with those and did a bit of a buying expedition around Western Sydney. What looked good on paper, what looked of value to me based on what I knew about Hobart once we arrived was completely bewildering. It was all over or very different to what I'd expected. The property in question that was the start of this brain or the seed for Ripehouse all these years later looked great on paper. As I mentioned, it was at the end of a quiet cul-de-sac, priced well. But when you arrived, you realise that the locals, a big compound of public housing, which has its good and bad points, and there's no judgment there, it is what it is. They were using that in numbers as a thoroughfare. They'd knocked the back fence down of that property and were using the property itself as a thoroughfare, a walkway, where the grass was actually downtrodden and there was a pathway worn, back fence knocked down to get to the train line. That's something that would be very difficult to pick up, and it was a real wake-up call for me because I didn't understand how these suburbs worked or what you could do there to purchase and value or praise and look at for growth. It was, for me, something I went back to the drawing board and I thought, well, I've really got to not take any shortcuts here. I've got to do my due diligence and understand why people live and how they live and what they value in these types of suburbs in Sydney, but then also right around New South Wales. So my wife and I, over the period of the next 18 months to 2 years, we went to a different suburb every week, really immersed ourselves, or even area, really immersed ourselves in how the locals live, why they lived there, what the values were, why they were valued as such, why tenants live there, why owner-occupiers live there, how that might change. We really got to know things. That's where I once again found comfort, and we could then start buying again once we'd gone through that process. So for me, it was about due diligence. I've got an analytical background, a process development background. It was all about a framework. How can I quantify or, quantify, I suppose is the right word, that locals' knowledge of living in Hobart and knowing that. How can I replicate that across the country? So it started off quite basic. We've built it up from there, and in 2011, Ripehouse was formed to really share my framework with other investors, and it's gone ahead with some really amazing features, and now we're doing some great things and helping hundreds and hundreds and hundreds of investors out there like yourself to analyse and invest in property. I guess that really is where we are today. So it did start off in having to understand remote markets. That's what Ripehouse is all about. It's to help us analyse and invest anywhere in the country, wherever the prime opportunity sits, and understand those places like a local would. So if you think about the suburb that you live in, you know the streets that are really going ahead and value is growing strongly, and the streets that potentially are not so much. You know how to assess them and stay away from. How can we do that reliably for every suburb in the country? And how can we then find properties and appraise them? So that's what Ripehouse is all about, and I'll use that as the backbone of what I'm going to be talking about tonight. Obviously, with application to March, where we are with our March research report and what we're seeing in the country for capital growth. So I hope that story did help a little, clarified or set the scene, I suppose, for where we've come from and where we're going. I'll jump right in. I'd love to hear some feedback, any points you'd like to make, any similarities you see in your journey. It'd be great if you could. Let's jump through. I'm just going through the chat there. I'll get to some of those questions towards the end. Okay, so what are we talking about tonight? I guess we're talking about a system. So this is my framework. You can see where it's come from, but now it's developed into a fully fledged system. Okay, I'm not sort of pulling numbers out of a hat here. Reliably, when this system is followed via the Ripehouse system, amazing capital growth results can be achieved. And I'm talking in some cases, which I'll go through tonight in case study form, 25% or above capital growth in the first year after acquisition. That is outstanding. If you think, well, that's really high, think of a suburb, or the average suburb goes up 7% or 8%. When you're looking at a suburb that goes up 10%, there are some suburbs, streets in that suburb that might go up 15%, and some that might even go backwards. It's about how do we develop a system that put us into the right suburbs, find the key streets and the properties that are leading the charge forward. So it does start with increasing our catchment area of interest, looking across the whole country for the areas that really are going ahead, get the LGA right in that area, find the suburb that's leading the charge, then the individual streets that are set for above average and amplifying the suburb's growth, the exact property type and the exact properties that people are demanding to live in and driving that growth forward on, not the white elephants that they're avoiding. Negotiate and buy at or below value, all part of delivering outcomes that are above and beyond what you've come to expect. And this is the end-to-end system. You need to get all of the layers right and consistent to be able to amplify your result each step of the way. Hope that clarifies things, because I'm going to drill down into each one of those layers tonight in application for our March research report. Okay, I just want to probably just set the scene. How much would a system like this be worth to you? If you could rinse, repeat it over and over and over again for each purchase and deliver amazing capital growth stories each and every time, do you think $5,000 might be reasonable for this type of system to access? What about a typical, say, advocate or agent cost of $10,000? Or what about, if there's no ongoing transactional costs, would it be worth, these are the type of numbers we're starting to talk about. And these potentially the types of numbers that are actually built into a lot of our new purchases across the country. These are the types of numbers we're used to actually paying for supposed good advice or systems. Let's just think about that while we're actually going through tonight. Because what we've done here at Ripehouse is developed a system, a platform, research tools for individual DIY investors to use, just like I have and evolved from back in my early days in investing. So, number one, get the pen and paper out, because tonight I'm really going to be trying to give a lot of value as we go through. You can take this away. It is all equally applicable outside of Ripehouse. It's a lot of common sense buyer behaviour, but sometimes that's not really reiterated in research or media or property itself. So it does start here in increasing your catchment area. What I mean by that, you need to look across the country for the absolute best growth potential. The chances that next door from you at this very moment are going to grow in line with the nation's best suburbs or streets or properties is not high, not a good chance. You need to potentially increase your comfort level, improve your research, your due diligence, your tools, and your acquisition skills to purchase anywhere in the country at any time to be able to reliably increase your catchment area of interest, the area that you are looking at focusing on to buy, to the whole country. That's the holy grail. Let's do this together, because I'll show you ways that we can do this, and we can take a couple of shortcuts to be able to do it. But that's the key. We need to be comfortable investing anywhere in the country at any time to access the absolute top-notch growth results for us. How do we do this? It doesn't start by looking at which state is going, at 7 or 8 o'clock on the property clock, as I'll show you in a moment. It doesn't start at the state level and going, this state looks great, I'll just buy in Queensland. You need to get further down and into the weeds. You need to drill down into that state. Look at individual LGAs, local government areas, and suburbs that are driving the state forward. You want to stay away from, say, regional Queensland or coastal or mining Queensland. You want to focus on southeast Queensland. And there's a balancing act going on at all times. The state level data is generally too general. Okay, so it's not our answer. It is good to give a little bit of context, but state property clocks are too general. It's not our answer to opening up our catchment area. Let's take a look in the Ripehouse software. I will jump in there right now. I have logged into Ripehouse, and I'm just going to go into my dashboard. Sorry, I've gone into a deeper page here. think you might need to log in. No, okay, we're over in our dashboard here. We've got our 5 layers of research tools here. I'm going to click on that and get it loading in the background, because at the top we've got our learning center. This is the Frontier Investor, which is our internal content platform. So you've got over 30 experts in the industry regularly contributing content. That all comes through on your feed there with other research, etc. when it's released, our monthly reports, any new learning modules or videos, etc. is all posted here. You can view all of those learning modules on the Learning Center. We've got some advanced research tools there, but these are the 5 daily tools that you need to be using, okay? So the state versus state analysis, LGA versus LGA, suburb versus suburb, street versus street, and property or advanced analysis down here. Okay, first one I clicked on is the state of the states. What you can see here is, say, Tasmania is in the firm growth phase at the moment, but Queensland looks to be already slowing down. What does that actually mean? It doesn't really mean much, because Queensland, you might have coastal, regional, rural, mining, all in the distinct slowdown or trough phases, but you might have southeast Queensland, as we all know, in the boom growth phases, a lot of focus and heat there. So as an aggregate, it doesn't mean much. It means that the state's in slowdown phase. One thing to mention here, while we're here, is you can see the live ticker. Whenever you see that across Ripehouse, it means that this is calculated as you load the page. So we're going from every property currently on the market or recently sold in Queensland, starting there, calculating up into the streets, into the suburbs, into the LGA, into the state, as you load it. We're doing that every day. We're going across the internet in Australia, like Google does as a search engine, and gathering up all for sale, for rent or sold listings and bringing them together for you. It's happening regularly. Within a day, we're doing all of that and calculating and providing the outcomes to you here. So you can see and you can monitor the pulse. Just like Google is gathering those listings together and bring them into one place, you can see the full listing history for all on-market properties, when it was first listed, has the price been reduced, the number of days it's been on market, etc. But right here, we're at the state level. Let's just use Tasmania as an example, because when we click on that state, it's going to load up our next layer, our LGA Research Assistant tool. I won't go into that yet. I might just set the scene about why this is important. Because we know, even though Tasmania looks positive, there's going to be areas in Tasmania to focus on and areas to stay away from. I just want to make this really important point before we proceed, okay? Because if it takes us 6 months to gather up all of the information to be able to look at which states are looking where or which LGAs are at the prime buying window in the property clock, if this is taking you a long time to do that, then by the time you've gathered all that information, it's worthless. It's not timely. It's not based on today. It's based on 3 or 6 months ago. And you sometimes might see this in research reports out there in the wilderness. Media takes a while for news.com.au as a not really specialised property house, obviously, to gather a news story together. Just critically analyse the data source and what it is based on. Because a research report might be based on top areas to invest in today, but that data might be actually from last quarter, even into last 2016. It's bought from a secondary source. It's gathered together. There's an interpretation added to it, which takes another few weeks. And then it's obviously produced and distributed. So sometimes by the time you get that report in your hands, it's 8 or 10 weeks after the fact and out of date. We are all about live, timely information. It's critical to your success, as you'll see later. Timing is everything. We want to put ourselves just before things are really going to start moving, and we want to, the longer we wait without much growth, the more opportunity costs we are accruing. But the longer we wait into that process and maybe buying too late, the more competition. It's a buyer's market. The more people fighting over each listing, prices are starting to move. We can't actually assess value. It's really hard to buy remotely. All of these things are starting to work against us. So it's about finding that buying window. It's critical to be using live data to help us in doing that. Okay, I might just elaborate. Any questions, keep them coming through. I've got a few questions there from you. I'll gather those up and answer them at the end, if that's all right. Thanks, Jean. I'll get to that at the end as well. Thanks, Anna. I'll get to that at the end as well. What I'm just illustrating here is the optimum buying window. So I've touched on that. If you're buying a year before any growth starts occurring, you obviously could have put your money into another property. Okay, that property would have grown in value, and the difference between that property that's grown in value and your asset that hasn't changed is opportunity cost. We don't want that. We want to buy here as time goes along to the right in the optimum buying window. Remember this, because our research has shown that it's usually only open for 3 to 6 months. So by the time we might give the recommendation, and then there's too much heat in the market, it's usually only a very short time period, 3 to 6 months at the absolute maximum. By that stage, the market's starting to move really quickly. You've got lots of people fighting over property, days on market, the time it takes to sell a property is at the rock bottom, but lots of sales ticking over. Now growth is really starting to drive. It's really hard to buy then, it's really hard to assess value, and you want to position yourself just before it, because when you're buying with the masses, you're fighting against them. If you're just before it, you're using the masses, the less sophisticated investors, and that's the real key here, the less sophisticated investors to deliver us the growth. And this is what this is all about. The whole framework is designed to be able to put us in front of less sophisticated investors and use that difference in skill level and the resilience of tools like this to be able to give us value and growth. So I just want to make that point really quickly. The buying window is sometimes very narrow and short. If it's taking us 3, 10 weeks, 3 months, 6 months to gather all the information together, we're missing that buying window. If we're just focusing on our area that we can gather up, our local area, and gather all that information together because we can do that within a week, then we might be missing out on other opportunities across the country. So Ripehouse gives us the best of both worlds. No growth equals opportunity cost. I think I've illustrated that point quite well. Let me know if that doesn't hit home for you. We want to be getting the absolute top performing assets when we purchase, and we want them to grow from day one, not in 2 or 3 years. Okay, that's critically important. How do we find the optimum buying window? So you've seen that we've gone in at the state level, into the LGA, into the street, into the suburb, into the street, into the property. It takes 5 layers of research to be able to work out, is it the right time to buy, and is this suburb or area going to be a top performer in the country? We don't look at previous growth as an indicator of future performance. There's no relationship. We look at predictive indicators, 121 metrics here at Ripehouse, to assess a market, an area, and try and reliably determine if it's the optimum buying window before very strong growth is about to occur. Okay, we've got really good at doing this. It's been in development since 2011, and obviously informally a long time before that. Because growth attracts attention, market heat, we want to avoid this heat, and we want to use these predictive measures to put ourselves before it. I will make this point once again. It's only a 3-month period essentially when this window is open. It's very particular. I might leave this here before I go into the suburbs, because what we're doing now is we want to look at all the areas within Tasmania. So if Tasmania, just for argument's sake, is at the prime growth acquisition phase of the property clock. For those of you that don't know, a property clock sort of goes in cycles. So markets generally go in cycles. You've got a slowdown after a very strong growth period. You've got a slowdown, a trough where nothing much happening. The market's recovering. Things are getting in alignment again. Then you have that turning, green shoots start to grow into a recovery and then growth phase. So the vast majority of your actual growth in that whole cycle happens in the growth phase, about 60%. About 30–35% of growth happens in the recovery phase. We generally want to put ourselves in that early to mid recovery phase and have that nice upswing ready for us. We don't want to be buying down at 3, 4 o'clock in the trough and waiting for a year. We want to buy at 6, 7, 8, 9 o'clock. Okay, so that's what we're looking at. At a state level, you can see the property clock as we've sort of seen, but now you can drill down into Tasmania. As you can remember, I filtered it by Tasmania. We can see all of the local government areas in Tasmania, and you can actually see the exact property clock information for each of these LGAs. You can see that some of them are at 2 o'clock, which is a slowdown phase. Some of them are at boom conditions, 11, 12 o'clock here. Some of them are in the middle ground. What we can do is we can actually filter. I want to see the LGAs between 7 and 9 o'clock on the property clock. This is my prime buying window. You can see you've got 3, Clarence, Dorset, and Glenorchy. So now you've gone from state into LGA. Let's click on the city of Clarence. Okay. What that's going to do, it's going to bring us into our next layer of research here within Ripehouse. This is now comparing individual suburbs within the local government area against each other. Before I just explain this page a little bit, let's just work out why that might be important. Because we want to find a suburb primed for immediate growth in this LGA, not 6 months previous, not 6 months in advance. We want to beat the masses, as I've said before, but we want to potentially target suburbs that have been lying dormant until those stars align. Those 121 metrics that we're tracking, they are aligning, and we are reasonably sure of the predictive predictions for imminent growth. Okay, we want to find the suburbs that are really leading the charge forward for that LGA, not the ones that are potentially lagging back away from the reasons why people are moving to that area. The stars have aligned in this growth phase. Growth is generated by demand. This phase is not suited to the buyer. So once things are really growing, it's not suited to the buyer. We want to buy in a market we can really negotiate in, potentially get a healthy discount off asking price. If it's been on the market for a while, we can really negotiate. The vendors might be in distress across the suburb. We want to be buying then. Okay. Growth generally continues in these markets when there's lots of people moving towards there, and I'll talk you through a little bit about the buyer behaviour in a moment, but growth obviously continues to grow, prices continue to grow until it meets demand, until that demand is now priced in and it's matched to the price. So demand is matched to price, okay? That's when it will then top out, and the market might not do much for a little while after that. We want to get that nice, healthy, full growth phase. Okay. Before I go into the individual suburbs, I might just go through an actual example here at Ripehouse. So you can jump over to the frontierinvestor.com.au. On there is a 4-part case study about Guy Williams. So he is one investor who's been getting some amazing results within Ripehouse. But the reason why we like Guy's story is because he's really kind, open with his time. He shares everything he can. He's really motivational with how he presents things in a very logical fashion. So you can read about how he got started within Ripehouse and how he manages his property, how he interviews property managers, how he negotiates, how he inspects them remotely, etc. But Guy purchased 10 properties in the first 10 months within Ripehouse. These are quite typical results when people follow the framework to the letter. Average annualized capital growth of each of these 10 properties was 25% in that first year. 105% cash on cash return. So if he invested 100,000, he got 105,000 back in addition to his 100,000. Average yield on each of these properties was 6.25%, so firmly cash flow positive. Amazing results. And you can go over to the frontierinvestor.com.au and search for Guy and digest his material. We've actually got all of the individual 10 properties there, dissected, the address, purchase price, rents, all of that's there for you to have a look at. If I do talk a little bit quickly, I do apologise, I get quite excited. Okay, Tom's just asking a question around the northern suburbs of Hobart. Susie's just asking a specific question around developments, which I'll get to at the end. And Lorraine's just asking a question around growth areas, which I might get to at the end. I'll answer this question, which is directly relevant to the area for Tom. And I might actually readjust. Just quickly, Tom, I'll answer your question in actually using the software here. Our job here is finding the individual suburbs. Okay, we can see we've loaded up Clarence. City of Clarence, we've got obviously quite a few suburbs here in Clarence. Each of these visual elements tries to give you a representation of what's happening in that suburb. So the higher the metric score, the higher our 121 metrics predictive measures of growth is showing, or imminent growth is likely. Higher this score, the more likely that is to occur. The higher the opinion score, the more expert opinion is out there in media, in our routine interviews. we are regularly interviewing real estate institute members, valuers, buyers, agents, advocates, selling agents, etc., in these markets all across the country, trying to get a feel for the pulse, but then also monitoring positive and negative sentiment in media, property media and national media, and we have a score attached to every suburb. So the higher that opinion score, the more positive it's been talked about, and potentially that word is already out. So already a lot of people are onto Warrane. Not so many people are investing there now. Warrane has potentially had its day. I think people have moved on from Warrane, just talking quite generally. Investability, that means that there are still properties on the market in the key streets that our system has identified. Not all streets are created equal. It doesn't matter if there's no properties on the market in the streets that we don't worry about, but we want to see nice, healthy investability. And a high income score means that rents are high, but also vacancies are low, rental volumes are good and strong. Okay, so that picture tells a story. And not much is really happening here at a suburb level in this LGA. Whilst the LGA looks good, there's conflicting stories at a suburb level, and we're not seeing things happening in a similar way for similar reasons. So for your purposes of your question there, Tom, I might go back to City of Glenorchy, which was at 7 o'clock, potentially a little bit earlier in the cycle, and see if we've got some more opportunity there. Okay, so we do have a little bit greener, a little bit more orange. We've got Claremont based on the health and value of this suburb, potentially our #1 pick. Having said that, I think there is a lot of heat now in the Tasmanian market, and investors within Ripehouse, which is this score is derived from, have moved on. Potentially heading into the late last year was the time to be buying in Claremont. So potentially not focusing on that really anymore. I will tell you, which I'll show you in a moment, which is more in our March research reports, the areas potentially left in Hobart to look into, potentially not in this LGA, if that's us answering your question, Tom. I might just elaborate on that directly. Yeah, when you say, I think they've still got, so Tom's just asked, northern suburbs of Hobart, do you think they're in the buying wind down or growth phases? So I think when you say the growth phases, if you can remember, the buying window might only be 3 months long, but then you might have 18 months, 2 years, 3 years of really strong growth after that. But in that time, you're becoming less and less sure that things are going to plateau. They might be plateauing any day, or in the early days of that growth cycle, you've got a lot of competition, and you've got a lot of competition in these northern suburbs now of Hobart. The growth is already 12 months in, it's been strong growth there for 12 months already. 12 months, 6 months was the time to be buying back in the northern areas of Hobart, or predominantly the majority of Hobart, 98% of Hobart, you've already missed the buying window. Now it's in that 18 to 3 year period of growth phase, which is not really your time to be buying. You want to be looking at that 3 to 6 month buying window in other parts of the country. Okay, so you potentially have missed your boat down here in Tassie, even though I'd love it to not be the case. I might just explain how we bring those, how we might define those stars coming into alignment, because the way that we do that, looking for an LGA in a suburb for above average imminent growth, ask any questions if this is sort of not very clear to you, because we're trying to look for ways of quantifying why people are moving towards a suburb or wanting to live there that might result in above and outstanding growth. Okay, so it's all based in human behavior, buyer behavior. This is how we determine if the stars are aligning. These 121 metrics are gathering together. First, you see an increase in demand in the local government area. What that might be from, you might have a lot of people wanting to come to the area. In some cases, the government has said, we want to have X number of people living here by 2030. They go and build a train line, an IKEA, Westfields, university, business park, marina, etc., etc., etc. Because of all of these new amenities, people are moving towards the area. Demand is going up to live there. Firstly, they test the water. They don't want to risk buying in a market they might not like living in. A job might not work out, so they rent first. You see rents growing strongly. You see yields growing strongly as well together because you haven't had price growth. Then you start seeing those same people and other investors coming into the market chasing those yields, buying. So about 6 months later, you might see sales volumes going up strongly. All of those renters are now going, I love it here, this is working well for me, I'm going to buy. And all of the investors who are chasing these strong yields to start with are now also buying. So this is now starting to become a really healthy buying opportunity. You want to just also check that days on market, the time it takes to sell a property, is stable or decreasing. You can have some circumstances where you've got lots more sales happening, but also the time it takes to sell properties is increasing. And that means that there's a lot of new properties being pulled into that market. So it's good to just have a check and balance and make sure days on market is steady or decreasing. And that's a sign that there might not be supply risk. And when all these stars are aligning, obviously there's lots more things that we look at, but that's when the growth is likely to be most imminent. Let me know if that answers or makes things a little bit clearer for you. That's how we do things here at Ripehouse. This is just to explain the Explore the Nation page. So this is the nation here. What we've done is we've gone into a state, into an LGA, into a suburb. We've found Claremont as leading the charge for this LGA, but we don't know how does Claremont compare across the whole country. You know, our prime growth opportunities, we've increased the catchment area, we've found and stacking together all of the prime growth opportunities. The way that we can do that within Ripehouse is by using these strategies over here on the left. And undercover strategy is the first, and you can see by the shape of the strategy that all of the suburbs within are very similar. I might just explain that. Because an undercover strategy looks like this. You have low opinion and sentiment, so not being talked about yet, no one buying there yet as a sophisticated investor, really strong high metric scores. Our predictive measures are looking, you know, off the charts. So we're getting in really early into these markets. Medium to high income score and high investability. Next, you would expect to see emerging and high opinion and sentiment. The experts are catching on. And then the sophisticated and then less sophisticated investors catch on, and it becomes a big green. So you can see that transition. Loosely, this is very loosely, you can see how it relates back to our opportunity buying window growth phase. Okay, so we're wanting to try and usually get ourselves around the undercover into boomerang, but sometimes there's still a lot of opportunity in the big greens. Okay, so it then becomes down to, can you actually negotiate on these properties? So I usually try and find one or two of each, and just call a few agents, you know, search around on a few properties, notice days on market, are you able to negotiate effectively? And that will, if you can't, if there's 3 other offers, the property's only been on the market for a week or 2, you're obviously definitely firmly in the growth phase. Okay, so that's more of a check and balance that you can do on the phone. If we were to look here in the undercover strategies, this has gone across the whole country and gathered together the undercover suburbs that qualify. So this is sort of hacked it a little bit. You've not going down in a vertical funnel, you've gone and joined up hundreds and thousands of different funnels, you know, LGA into suburb into street together, and you've found all of those that are really outstanding. Okay, there might be a few areas. One that is actually in our March report for the first time is Rutherford in New South Wales. We get a lot of questions around New South Wales. Rutherford is one that is starting to show really strong green shoots for growth once again. Obviously, this Hunter Newcastle area has been downtrodden over the last 5 years since mining sort of gone backwards a little bit. Prices haven't done much, but now you've got some interesting employment opportunities coming through this area, and Rutherford is an area that is very well priced. You can come in and successfully negotiate and purchase at value or under. It's looking quite positive. When you come into this suburb, which is this is now, I suppose, the core of our March research that I'm sort of wanting to talk about. The report does contain about 15 suburbs. Rutherford is only one of them, so keep that in mind. This might not be for you. It might not be your risk profile, your price point, your area of, you know, you might have land tax issues in New South Wales. It might be the types of property, yield, etc. is not going to work for you. So the rest of the report, and obviously the platform is very bespoke. You can customize it to your exact needs, but for the purposes of this illustration, I'll use Rutherford. When you get into a suburb, okay, so I'm just reiterating that, we really want to turn the screws. We want to find the individual streets that are going to amplify our growth. We want to be positioning ourselves in the streets that are potentially going to have 15% growth when the suburb only has 10, and some streets in that suburb have negative growth. We want to get ourselves at that top point of growth in that area. Just think about where you live. There's some areas that you know to be avoided and some areas that residents are drawn to. They are where we want to reliably invest in. The street is critical to get right, and every provider, every research platform, etc. in the whole country, I've never seen, and I'd love if you've got an alternative, to be able to show how growth at a street level is related and reproducible, and show us this street level intelligence. It's critically important. It's a major component of hockey stick growth. Okay, how important is it? I'll show you some quick stats, because when you get a combination of what we've found with our research, there are 5 factors that when you combine together can amplify your suburb results by 21.9%. Okay, so that means if the suburb went up 4%, the sweet spot, as we call it, those 5 factors would go up almost 5% in the same period. What does it mean in Sydney for the next 10 years? Potentially $240,000 of extra capital growth above and beyond that you wouldn't have otherwise potentially been able to access if you got that street level right. It's very important. And this is, I suppose, take out the pen and paper again, because these are the 5 factors that our research has shown result in above average growth, low public housing, lots of the in-demand property types, so lots of houses if people need that, lots of 3-bedroom houses if people needing that, and lots of strong tenant demand. So above average rent, above average yield, and above average tenant demand, or above 33% tenant demand, sorry. This is the sweet spot. When all of those 5 things are combined, that is a street area that qualifies. It's usually only 10 to 15% of each suburb. Okay, not all suburbs have it, but we want to be able to find it for every suburb in the country. I also wanted to probably just make the point that amenities and public housing have a dramatic effect on appraised value and growth. Okay, you can see these charts because just after 1,000 metres from the closest major transport hub has a really strong positive impact on value. About 250 metres away from the closest school is optimum, and out to about 1,200 metres to the closest shopping centre. These are things you need to start thinking about, because Ripehouse is all about location and value and growth. And we make it our mission to be able to tie these things together and provide it to you in an automated fashion, which you'll see in a moment, to be able to empower you to make buying decisions. These things are critically important to get right. Another thing, expect to pay 25% more than average for the suburb to be in the street that has 0% public housing. This is a huge factor for growth and appraised value. If there's 18% or more public housing in the street, expect to pay 20% less than the suburb. Amazing changes there based on how much public housing is in the street. Okay, with that in mind, let's look into Rutherford. So this is the main map-based analysis page here at Ripehouse. You can spend half an hour going through it. There's a huge amount of detail, but I'll just keep it really simple. Each of the red icons are on-market properties currently you could purchase now, established dwellings. The darker the red, the higher the price. You can see the quartile pricing down here in the bottom left-hand corner. 338,000 is the suburb median, $350 a week rent. Okay, you can see exactly where the public housing is by clicking on the toggle over here on the left. The darker the red, the higher public housing. 56% public housing, a definite no-go zone. As you can remember, we want to target low public housing. You can see exactly where the tenants are demanding to live, or the owner-occupiers are living here in the green, tenants over here in the yellow. You can see exactly where the houses and units are. Lots of green is houses, lots of yellow is units. Above average rent in the purple, above average income in the purple, and the darker the yellow, the higher the yield. So you can see exactly which streets to focus on. You don't need to get your pen and paper out and map all that together, because we make it easy for you. You click on the Ripehouse sweet spots, you click on the capital gains toggle. It will automatically shuffle those 5 variables that I spoke of before. You can click on Apply Custom, and you'll see exactly the streets to invest in within the suburb, okay? That's where you need to focus on. These are the areas that our research has shown potentially to grow faster than any other. Okay, next job, you've got 83 properties on the market. We don't want to look at all of those. We only want to look at the properties that are most in demand in these streets. If you did notice, when the suburb loaded, it told us which properties were most in demand. Otherwise, you can click on the View Suburb Report and it will tell us again. So 3-bedroom houses, most common and in demand. So I want to put a filter. I want to get our 83 properties down to a more manageable number. I'll click on Filter Properties. The Custom Strategy Areas. I want to filter properties only located in those orange custom areas I've just applied. And I only want to see 3-bedroom houses. I'll apply that filter. That will take a few seconds to load. There's a lot of number crunching going on behind the scenes. Now we've got down to 7 properties very quickly. One of them is a unit. Sometimes the agent's a little bit optimistic with how they describe a property, so that one might slip through the cracks. Number 1, Jason Place, has been ordered by price first, discount amount first, sorry, and then price. So you will see this property's been discounted 4% since it's been on the market for 43 days. 1 Jason Place has hit the market 1 day ago, and we can start there. Click on the property, okay, because I'm going to skip back to the slides just for one moment and just say how we can use all of this information to negotiate effectively and like a pro. In these remote markets, the key to beat the heat, the masses, we want to assess value and actually be able to buy below it. Okay, there's no point if we're getting caught up in the heat and the momentum and can't work out what the value of the property is because all the comparables are going up, etc. We want to be able to reliably assess market value, condition, find comparables, and negotiate. What types of information can you use in this negotiation? Well, you can see obviously the condition of the property. This one's presented quite well for sale, quite tidy outside. Obviously, I can click through and look at some larger images. We need to do a bit of a condition assessment for this property based on the market, not based on Mossman or Dubbo. It needs to be based on Rutherford. So it takes maybe looking at a few images and a few properties to get a bit of a feel. But this one does look average to good, quite tidily presented, 620 square meters, 3-bedroom, 1 car, 1 bath, 2 cars. Okay, only been on the market for 1 day. So this is, no distress in this listing yet, obviously. Our algorithms automatically assess the condition of a property based on the settlement and the type of property that it is, okay? It's got it right in this case, but if you disagree, you can override it and it will learn from that and get better. Okay, it's been listed for $329,000 in the 23rd of March. So you can see if it's been rented previously and if it's been listed. Obviously, if it's been discounted, you can see all of that there, and that's what you can use to negotiate on. You can see suburb and area level information. That's more of the same that we've seen before on the main page if you've done your job right there. This is where it's going out and finding the 5 most likely comparables. It looks at other properties in similar condition, properties in public housing areas, same number of bedrooms, within 3 months that have sold, etc. So you can see those are all quite tight there. If a property is standing out to you to be a higher price point, you can view those images. And if you think the property is superior, which this one is, you can remove it. Okay, so that one is $395. It is superior. You can basically go back and forth on this until you're really happy with the 5 comparables. I do encourage you to do that. There's nothing worse than an automated appraisal that is completely wrong. You need to be empowered and use your comparables to negotiate on and be really comfortable with value. When you've got your 5 comparables, take them through to the appraisal tab. It will show you how that $310,000 base comparable is affected by school, shopping, transport, public housing. As we've seen before, final appraisal on this property, $295, asking price $329, estimated rent $340. Okay, you can see how powerful that is. It's an end-to-end system framework to pinpoint the exact properties set to deliver us amazing growth from day one. That's what it's all about. Okay, I'm going to skip forward because I've got lots of questions coming in. I will get to those at the end. They all do look quite subjective, but do please, if you've got any questions, keep coming in. There's going to be a really nice session after this, I think, by the looks of it. I might just take a breath. I do go a little bit quickly. I do apologise. I guess we're all here for similar reasons, and I might just ask you the question, are you looking for amazing growth in a property? You might be looking for renovate for profit. You might be looking for development. You might be looking for cash flow. But if you can get amazing growth in that first 12 months, it really does help all of those more advanced strategies, okay? You know, it really does grease the wheel. If you're holding a property, renovating it, or doing a development, you want to be buying in a market that's going in the right direction. You might not necessarily want to hold it for the long term, but you want to be able to sell it and have nice, strong organic growth in the time that you hold it. Okay, so growth is really important. A lot of the predictive measures is about getting us into markets that have a really healthy dynamics, and we can then sell back into or refinance through a strong upswing, okay? That's what we want. We want to sell into a seller's market or hold in the seller's market, okay? The system has been developed to do that very easily, and that's why I asked that question, just to make sure we're on the same page. Okay, I might just go into a little bit of a story here. This is a Ripehouse user named Lauren. She purchased or she came and joined us as a subscriber a little bit before Christmas, late last year. I might just take a breath, excuse me. So she subscribed with us late last year. She's quite typical of what we see here at Ripehouse in terms of, she is someone who, whilst actually attending a seminar, she spoke to the person next to her on one of her breaks. That person, as they were talking, as you do, spoke and talked about Ripehouse, check it out, check it out. That, you know, whether the seminar that weekend went well or not is separate to the case, but it had been 18 months that Lauren had been looking, educating herself, trying to invest in her first property. She'd had the money, she'd been able to go, she hadn't purchased in 18 months. She'd been to multiple seminars, and this is probably something that I see over and over and over again. She's now got conflicting information. She's got analysis paralysis that's forming. She's been to multiple seminars, multiple educators, talking to people. She's got conflict in the ways of doing things. She's getting confused. 18 months has caused a tremendous amount of pressure on Lauren back in late last year to buy and to get this amazing result because she's been looking for so long, okay? That stress, a strain is causing paralysis. So Ripehouse was able to cut through that for Lauren. It made sense. Ripehouse reports, the framework, etc. We've got live chat support, phone support. It's all designed to help and support you buy quickly, cut through all of that noise, but buy, most importantly, effectively in a really strong growth area from day dot, and be able to do it again and again and avoid the paralysis. Okay, that's what it's all about. Capital growth is key. Lauren actually came to us with a renovate for profit strategy. Really high risk. She wanted to get this big bang, shoot for the stars. Taking all this time to research, she wanted to get this amazing result off the bat. Wasn't getting close to even buying yet. Capital growth was the key. She could see that from day one. It was simple. Lauren's, in her own words, it made sense. 3 weeks after buying or joining us here as a Ripehouse subscriber, she actually purchased her first property. Off and racing. We'll have to touch in with Lauren. It's been about 6 months now, how that's gone. It'd be great to do so. I'm not sure if you're on the line, Lauren, but it'd be good to touch base one way or another in the next few weeks and talk through that. But I think that story is really important because it's quite familiar here at Ripehouse. A lot of analysis paralysis, a lot of people going, which one should I do? What should my next strategy be? Where should I buy? What should I, should I do a renovate or should I look for cash flow or growth? What it is, it all comes down in a majority of cases to outstanding growth and cash flow together. When you get that combination at the levels that we can try and, the system can try and put forward for you, nothing's a crystal ball, but that really makes the decision quite simple when you see it in those terms. Okay, let's move forward really quickly. I'm trying to get to this Q&A session. I'm about 7 minutes behind time, so I do apologise. Okay, before I go on, I just wanted to say a big thank you. If you've made it this far, you're obviously pretty excited about property investing, about research, about Ripehouse, whatever it may be, but you're pretty excited. thank you for taking the time out on a Thursday. I'm pretty excited to charge towards this growth and be part of that with you. Based on the fact that you're here, I'd love to. I do feel that you are a perfect fit for Ripehouse. We're a community of DIY investors, some sophisticated, some just starting out, but we're all working towards doing things, amazing things in property for ourselves and our families, creating amazing wealth for this generation, but even into the next, our kids and grandkids. That's what it's all about. Based on the fact that you're here, you've taken the time out, I'd love to extend to you an exclusive thank you offer. Ripehouse is generally, or it is only available as a subscription service. The recommendations you can see are very specific. They are very scarce. They are very valuable. You can only access the recommendations via the subscription service. We keep that under lock and key. You have to join and be a subscriber to get that. An annual subscription is what we ask to justify that commitment and to allow us to continue to invest in our research and our platform and evolving and supporting you, the investor. Okay, so the Ripehouse subscription is there. It's generally $1,597 per annum. Everything you've seen tonight, reports, etc. As a special thank you tonight for coming and joining us, I'd love to offer a $400 saving on that, bring it down to $1,197 per annum. It's also inclusive, as it's been on the screen there, 12 free research reports. So every month we have our Capital Growth Report, which is all of the best bits of the research platform put together for you in a digestible format. So LGA, suburb, street property recommendations for our top area picks. They might not be perfect for you, but our staff can help you identify the individual suburbs within that report that might be applicable to you. Okay, so that's there for you, all inclusive. Normally, if you buy them off the shelf, they're $97 each. I'm including that's over $1,800 of extra value tonight as a big thank you. Only available until 11 p.m. and then the doors are closing. I like to get everyone moving together. We're on the same page. This is a short thank you window that I'm only extending until 11 p.m. tonight. Some other people that do use Ripehouse, got researchers, educators, buyers agents, investors, people just like you, but also professionals in the industry. This is how you lock in this special thank you offer. Before I jump over into the Q&A session, right now, let's do it together. I'll take a breath because we go to www.ripehouse.com.au/bonus. Okay, when we're on that page, we click on the red Get Started button. Payment is enforced by Stripe, which is best practice, global payment provider. Your information is only given to Stripe between you and them, not us, and securely transmitted to them. I might just go onto the bonus page so you can see how to do this. So just scroll down past that lovely video to the big red Get Started button. You can see some other people we work with in the industry and respect and have done things with in the past, but you want to click on the big red Get Started button. Enter in your name, your email, just doing this quickly. The thank you offer is automatically added if you come in via the bonus page. Click tab from that. It's just applying that offer. It takes a second or so. Then you see the subscribe button going bright red. Click on that. And it will load up the payment pop-up. So that's your credit card number, your month and expiry. Just make sure that the 1197 is here on this button and the $400 thank you offer has been applied. Okay, so I'll encourage you to jump on and do that right now. I'll skip now into the Q&A session. Let's press mute for a few moments. I'll gather our thoughts, these questions together. Please, if you don't want to stick around for the Q&A session, I really do thank you for joining us, taking the time out. I hope you've learned something. I hope it's opened your eyes up to a new way of investing. Hope you've sort of learned something that you can apply outside of Ripehouse. For those of you that do want to stick around, let's take a minute or so to gather the questions together, and then as long as it takes, I'll continue to go through them with you. There will be a recording coming out tomorrow. I'd love to hear your feedback. Please jump on email, live support. Let us know what you think of the webcast. Anything we can improve, we're always trying to work with you to deliver amazing results for investors. So if not seeing you on the other side in a minute or so, thank you for attending. I'll talk to you soon. Okay, back again. Thanks for the lovely feedback there, you. I might jump in next. First question is from Jean. Do you have to go state by state, or does it bring up the whole of Australia for whichever strategy you are using? Okay, Jean, might just clarify there. I did do two different, you can use the system in different ways. There were two distinct ways I did use the system then. So one of them was starting with the state, finding opportunity from that point downwards, so state into LGA into suburb. The other way you can do it is by using a distinct strategy, so undercover, boomerang, big green. When you click on the strategies, it's doing that for you. It's going through all of the state, LGA, and suburb combinations all at once, hundreds of thousands of combinations, and it's only finding the best combinations that satisfy that strategy and bringing it back to you. Okay, so potentially I'd recommend using those programmed strategies as a way to get to the absolute cream quickly. I hope that answers your question. Adding keywords to the search will be a great tool to have, e.g. deceased, bargain price, etc. Really good feedback. In terms of allowing search to occur based on the descriptive text used by the agent. The reason why we haven't implemented that, we do have all of that information. It wouldn't really be a very big job for us to do that, because what it will be doing will be giving you a property back that, based on the descriptive text from the agent, is in line with your strategy, but you've got no context around that property. You don't know what the street's like. You don't know what the suburb or the LGA is like. We try and encourage you to start at the other end. Even if you do have a state that you have in mind, or within 2 hours of where you live, you can still start at that 2 hours from where you live and work down to individual properties. You might arrive at 20, and then within those 20, you're looking for these descriptive texts. But if you find a deceased estate in Timbuktu, you don't know, is it going to be in that buying opportunity or that window? It's not in context, and that's losing a lot of that value. You need to look at things as an end-to-end research or methodology to be able to access these, the top or pinnacle of growth opportunity. Hope that clears that up. Okay, so another question here, does it help find subdivision or corner blocks? You can, it doesn't specifically look for corner blocks, but you could, as you saw tonight, you can see the lot size information around if it's a subdivisable size. Growth while we reno would be good. There's another question. Yes, I guess what we sort of talk about is, just another question here. Recently did a reno for 270, sold, purchased for 270, sold for 380. Growth whilst renovating is good. One thing that you see, I guess this is a question, when you're doing a renovate for profit, are you looking to hold or sell? Some people are looking to renovate and then hold. that's when you're looking at a pure growth strategy. And then, so you start with a pure growth strategy and then look for unrenovated properties in those areas. If you're looking for a renovate for profit and then sell, you're looking for areas that are potentially going to give you the most uplift in value, and then potentially selling into a market that has a very strong selling dynamic. Generally driven by owner-occupiers. If you're taking a shortcut, under $500,000 price point, you're looking at tenant-backed markets predominantly at that price point. You want strong growth markets. So in the 12 months or 6 months you're holding a property, you've had a nice uplift, and then you're also selling it into a strong selling market where you've got a lot of competition from buyers. So a growth strategy is really a good way of starting. Tom's just asking around West Moona Glenorchy. Moona is actually in our research report this month, Tom, so look out for that. Also chat to us on live chat support for any further information on Hobart or Tasmania. Okay, Susie's just asking, can we use the software for small scale developments? What formula to use, capital or flip or reno or develop? Please advise. So definitely can use it for small scale developments. I'll be looking more for undercover areas. When you come into big greens, you've potentially had a lot of eyeballs on the area for a long time. A lot of developers have already bought larger blocks, etc. You can see the lot size information, but I would be really strongly advising really outstanding capital growth from the platform and what that can deliver, focusing on undercovers, potentially into boomerangs. Markets that you might have to go out a little bit on a ledge. You might not have a lot of experts talking about it yet, but you've got really strong growth dynamics. The buying window's opening, all of our predictive measures are aligning, and there's potentially a lot of larger blocks still on the market. So that would be how I would structure things in that conversation. There's a few other more very specific questions. I'll stay around offline. I'll turn the audio off and I'll answer those via chat communication. Please, if there's any final questions that are quite general, I'll stick around and I'll get to each of these individual subjective questions one at a time. Please, can you explain boomerang again, please? Okay, so we've got undercover is when the predictive measures of growth are really good. So I'm not sure of your actual name there. FDFSD is the question that I'm asking. That was your name that you've entered. I want to just clarify what an undercover. So Chen, how are you? Undercovers, I want to just clarify what an undercover market is and how that transitions to a boomerang. Okay, undercover markets are areas that have outstanding market health, the predictive measures, lots of properties that you can negotiate on in a sweet spot street, good income, really healthy markets to buy in. No experts have been mentioning it or looking there yet, and definitely no investors have turned there. So very early on in that cycle. When experts start talking about the area, our software monitors all media. We have formal interviews that we actually are constantly doing and updating expert opinion. When opinion is growing, it becomes a boomerang. And then after that, when the investors in the nation start moving towards that area en masse, it becomes a big green. Still a really strong growth market, but maybe too much heat. Okay, we're tracking investor momentum within Ripehouse. Really strong indicator, leading indicator of imminent heat in the market. Hope that's clarified that distinction there for you, Jen. This slide here might be the best one, which will be on the recording to clarify that for you. So I'll just skip back a few. And I'll leave that on the to end with. So this one here is a really good. You can see how it actually it goes from an undercover, how the shape changes into a boomerang, and then how the shape changes into a big green. Hope that clarifies things there. Thank you for your time, everybody. I might leave it there. As mentioned, I'll stick around to answer any further questions via chat, live chat within the page or email. Until we speak again, happy investing and thank you for your time.